Welcome to the Scottish Property Podcast. This is a show where we aim to educate, inspire and entertain through real life stories and interviews from people in the Scottish property community.
As always, thanks for listening and give us a follow on social media and subscribe to our YouTube channel. Remember to join us at our monthly networking events on the first Wednesday of every month. Tickets are available on our website. So without further ado, we'll just cut straight into this week's podcast.
So welcome to the Scottish Property Podcast.
Thanks for having me.
Cameron Leslie from Go Financial Services.
How you doing? Thanks for having me.
So I want to get you on because I think one of the biggest links to growing a property portfolio and property business is the finances. It's a good broker. The amount of times I've went through brokers where they just don't fucking get it.
Absolutely.
And then you speak to guys like yourself and other guys that Go Financial Services and then they come up with something.
Absolutely.
Like, yes, you can creatively do it. So like, give the guys a bit of background on yourself and what got you started into this space.
So I started, it's funny, I actually originally started off as an engineer. Quite quickly realised I'm not an engineer, I'm a people person. And I started mortgages when I was 19, funnily enough. So I was like baby-faced. I'm still quite baby-faced, but I was even more baby-faced.
What age are you?
24.
Right.
But so I've been here for 5 years now. But I remember going to my first meeting being like, I haven't even got a mortgage myself, like how are they going to take me seriously? But to be fair, it's worked out well for me. I've now got 6 guys, 5 brokers, another one coming on board. So Greg made me MD in January, so
Brilliant.
strength for strength.
It's testament to it. I've put an investor friend of mine who's invested in property since 2005 and he's got a decent portfolio, was told by his current broker that there's nothing you can really do right now with it. I see Stevie Clark buying portfolios all the time. Surely I can fucking do something. Mm-hmm. He speaks to you and all of a sudden you've unlocked all this equity and he's waiting to buy a massive portfolio. Okay?
Absolutely.
So yes, to put
Is this your business?
Aye.
Aye. That's amazing, mate.
I know.
24 years old.
Aye,
You've built up like that. How long have you been going now?
5 years. It's coming up for 5 years on dot. It was October 2018, so that'll be 5 years.
Nice.
That's awesome.
It's good, mate. It's good. And you've got a good bunch of people around you. It's really good to see.
That makes it half the battle. See, having it when it was just myself, and then on COVID, my best mate Mikey, I grew up with Mikey, and he had done business at uni, and he'd say to me, "Look, you got any lenders that are doing graduate degrees? Like, why the fuck would you want to do graduate degrees and get some cunt coffee? Like, come to this with me for 6 months. If you like it, then boom, you've got a career. If no, you've got a reference." And he's flying, so that's worked well for him.
And do you know what? It's people would see the age as a negative thing, but I see all that shit as positive.
100%.
If you're young, fresh-faced, as Cameron is, when you look this up on YouTube, you'll see what we're talking about. When you look at
Compared
things
to us, obviously. Old haggle.
If you look at things from an optimistic point of view, you know what I mean? How can you get things done? As the people that have been a broker for 20 years.
You're set in your ways.
I've set my ways. This is where I'm going to. This is a lender I like dealing with. And I'm not going to bother
100%.
preaching on. But
the amount of business we've picked up for brokers like that, they're like, I've dealt with my current broker for like 10 years, and I had one. I couldn't believe it. I was like, people just must not want to have business. She was like, "Oh, I'm looking to buy a HMO and do all this." And he was like, "Why do you want to do that?"
Aye.
So
like,
you've got a fresh face and you've got a fresh approach to mortgage lending. What cuts you above the rest?
Well,
then?
Here's a funny story. I remember, obviously, because we are directly authorised and regulated, you have to do CPD. So I remember one of the first times I went to CPD, I went with Greg. Greg does our compliance, and I was it was legal in general, we're doing it, bonus sin. And Greg goes to me, "What do you see in the room?" And I remember thinking, like, what's some sort of what's a clever answer, like money, opportunity, and I'm like, don't know. He's like, old white men. And I was like, he's actually spot on. I'm the youngest here by about 30 years. He's like, you've 30 years in all these people. He's like, didn't see that as a disadvantage that you're young. It's an advantage because
you're the fresh, you're the hungry one, you're the one with the energy. Yeah, 100%. Absolutely. No, I get it. And we wanted to bring you on as well to talk about finance markets changed drastically. Like
I mean, what time to come into it.
Aye.
If I'd done it 10 years earlier, it'd have been just plain sailing, just free money basically for 10 years.
We were just saying in the market update that there's been 14 consecutive rises in the
base rate. This is the first time since over a year ago.
Yeah,
that 18 months
kept it as is.
Yeah, but like that marketplace changes all the time. Like we're putting mortgages through constantly, and it's like which lenders have got an appetite for what. I mean, I suppose that'll come down to your relationships with the BDM. Is that right? For
100%. Now, because the types of lenders we deal with, I was actually meeting with an asset finance lender yesterday, and they had like a great. It was like I'm quite pictorial in the way I sort of process issues and whatnot, and it was a great infogram, and it was like tiers of lenders and where they sat. So you had tier 1, tier 2, tier 3, and you could sort of see it like that. And I thought, that's actually brilliant. So, I mean, if you think tier 1, like your TMWs, tier 1's typically like your vanilla lenders.
Right.
They're really good on rate. And then out the way at the bottom, you've got... Like,
So these will be owned by the big banks. So
Building societies, big
TMW is
banks.
like owned by...
nationwide. They're a building society.
So these are high street.
And then on the other end, you've got like Mercantile Trust Together, who are they'll lend, but you're going to
You'll pay for it.
pay for it,
Yeah.
and everything in between.
Aye, and that's the things. People keep going about the right now about the interest rates, but the interest rate's not. I've found that interest rate's not really the thing. It's the flipping arrangement fees that have just changed drastically recently.
So obviously, as you all know, it's swaps are what fund. Now, not every lender's funded by swaps because building societies, they're deposit funded, etc. And some are a mix. But as a good indication, swaps now.
Hang on, let's because like all this jargon, right? So we're kind of familiar with it.
Yeah.
But let's just talk for the listeners. We'll try and kind of bring it to a base level swaps.
So
swaps.
rates.
Right. So I'm a bank. I'm a bank, and I sit down and go, right, I want to take £100 million to lend out at 5%. They need to go into the interbank market and borrow that money at a rate. So swaps are effectively the mechanism how that's priced.
Right.
So and that obviously changes. That's why rates they'll constantly change every 2-3 weeks because swaps are up and down, and they're being more volatile recently. So.
And what does the bank look for a certain margin, like 2% on what they can borrow?
So I mean,
or?
again, every bank's different. So a lot of commercial lenders, they're kind of base rate, but fixed rates are what price are the main driver of what. Sorry, swap rates are the main driver of fixed rates. So if you really want to geek out and you want to see what my fixed rate's going to be, tend to look at what the swap rates are, and you're kind of bang on because I mean at the minute I think and it gives you if you type it on Google I think it's Chatham Financial, if you go down at Sonia swap rates and it gives you the 2-year, 5-year, 3-year, 10-year. So if a lender's going to borrow money to lend to you for 2 years, that's what's going to cost them. So they're going to have to obviously price in a margin. Now at the minute, I mean you're talking it's like I think it's low 4s. I checked this morning for a 5-year, I think. I can't remember off the top of my head.
Yeah.
But
it was up over 5s before, wasn't it?
I mean, it was. I remember I was on holiday in Portugal, and I'll take a wee 5 days sort of half break, half working holiday, and I remember just like looking at swaps every day, going, and Ewan was like, "Mate, you seen the swaps?" I'm like, "What the fuck's happening here?" Like it was just like up, and I'm like, "Fuck, why when I'm on holiday?" Constantly when I'm on holiday, but.
Just a quick thing to add in there. A lot of people get a little bit confused because they put so much attention on the base rate decisions. But that's only affecting certain type of mortgages.
So if you're on a variable rate, so typically, and if you've ever had a fixed rate, so if any listeners of this have ever had a fixed rate, you should have been given a key facts illustration either for your broker or whatever lender you went with, and it'll say in that obviously for the incentive period. So if it's a 2-year fix for the 2 years, obviously 5 years if it's 5-year, what your payment's going to be, and then it'll revert to what's known as the lender's managed variable rate. Now that is based on the banking the base rate. So what you'll see is a lot of people. I've got a case now where a guy 10 years ago bought a property and he's like, I'd like completely forgot about it, like fired and forget, not even thought about it, and he was getting letters through the doors like paying like 10.5%. He's like, how the fuck's that? Because obviously when he's took that mortgage out, I mean base rate was what? I think it was less than 1%. So his fixed rate was probably 2 or 3%. Yeah. And then it's went up to base rate plus 4.5 or 5% or whatever it is. And now it's like when base rate's at 5.5, he's paying double digits.
Put a bridging loan on it.
Or trackers as well. If you're on a tracker, but that won't. Most buy to let investors are not taking out trackers.
It was a big thing. It was a big conversation that we had sort of 2 years ago, and they are more. I've done a lot more of them in the last 12 months than I've done previously. I've never done them previously because
everyone just fixed them.
I think the lowest rate I ever seen was in COVID, and it was a TMW at 0.9. I'm going to say 0.97 or something. And I remember being like, "What?" Like I worked it out, and it was like 120 grand. You were paying like £97 a month. Interest only.
Bring back those days.
But obviously that was like a 1 year fix with like a 2%
raise fee. Never right?
Fucking gone.
That's free money. No.
So I'd like to try and ask a few questions so that the both spectrums of the listeners can get good value from it, because like I scaled up buy-to-let portfolios quickly, and to me the key person in that is the broker.
Absolutely.
The person that can get you the finance to complete quickly, the person that can exit your short-term finance onto long-term debt as quickly as you can, get your money back out of the deal and allow you to keep going. The people that will buy it on a deposit and they'll hold it for 6 months or a year and then go and refinance it, that's a slow progress. So can you give some examples of what someone would pay if they were starting out their buy-to-let portfolio right now? how they would fund something, scale up their portfolio quickly, what kind of fees would they pay to do it?
Aye. So, I mean, if you want to go at scale, you have to either have a lot of cash, which a lot of people aren't in a position to do that, or, I mean, the buzzword's always, is it BRR? There's not many R's, I can't remember, but it's buy, refurbish, refinance effectively. So, you're buying something in which you can add values, I've probably talked about before. You do the refurbishment, you've added the value, and then you refinance to the new market value, you get your money back, and you basically just go again. You're recycling your cash. Now, where I see a lot of people, like you say, it's a slow process, is they're kind of operating on wrong information. It's true that it's the 6 month rule, but it should really be called
right there. 6 month rule.
Should be called the 6 month guideline, really.
6 month,
if I'm being honest with you, because the 6 month rule is misleading. It's not a rule.
So just explain that quickly.
So what I mean,
the idea behind
a lot of
that is.
lenders, if you buy, I couldn't tell you I used to know this, but the legislation behind it is, I don't know if it's legislation for the Scottish Law Society or if it's anti-money laundering.
It was something to do with anti-money laundering, wasn't it?
It's something to do with that. I should probably know that. But effectively, for 90% of the mortgage market, if you buy something January 1st, you can't refinance it to another lender, because any other lender that's going to look at it, they're like, oh, you've
only just bought it. Right?
It's technically a day one remortgage, you call it.
This all kicked in after the last, basically the global financial crash, was it not?
Yeah, but it didn't,
once the lenders came in with a stricter rules.
I started lending criteria, and I think it was only 4 or 5 years ago when they started to really push the 6 month rule. But like you say, it was only a handful of banks that went with it, and people just took it as gospel that
it was
you
the high
can't
street.
refinance
I mean,
or you
all the
can't
high
sell.
street, they're all there, and it affects residential mortgages. We've actually seen John Morris talk about this yesterday on his Instagram, where if you're flipping properties, it's something you've got to be cautious of, because you can buy on a bridge, get in, get your refurb team, and do it really quickly.
But you can't exit.
But your first time buyer is going to be buying with like a Halifax or something like that, and it's like, well, are they going to be all right with it?
Owned that for 2 or 3 months.
You know, so that's something you've got to be cautious of. Even if you're a developer and you're thinking, actually, I'm not building a portfolio, that doesn't affect me. It still does in some regard. But back to the original point. I mean, if you're looking to grow a portfolio at scale, you need to be aware that that's no like a hindrance. I mean, you'll have to. You're operating with I think in Scotland, there's 6 lenders that'll do it.
Yeah, they won't follow the 6 month rule.
That won't follow the 6 month rule. So they'll lend to you on day one, and there's even caveats to that. So like Aldermore, they'll not give you the full market value. They'll give you 75% of the original purchase price plus evidence. Say if you spent 10 grand on refurb, they'll give you the 10 grand on refurb as well. So there's wee nuances to it, and this is important to dealing with a broker
that's on the ball.
That's on the ball, knows what they're talking about, because the criteria changes all the time.
Yeah. I think the lender's appetite changes all the time then.
100%, aye.
Because I find that a lot in Aberdeen. Like some lenders will come into the market, they'll be there for a 6 month or a year, and next month they're gone.
Aberdeen's a strange market in that way. I mean, I was actually talking to you about this yesterday. I done a case, and it came through a sourcer, and my client bought a property that was, you'll see it yourself all the time you buy in Aberdeen. I think the home report was like 115. It was like 18 months ago. He had a
it's not worth 50.
He got an offer agreed at 90. So he's like, oh, I've got 25k below market value. Yes, I've got a great deal here. I'm going to stick a kitchen, bathroom in, revalue at 130. He bought it for 90. He spent like 15, new kitchen, new bathroom. I took it to 2 different lenders, 90.
Yeah, I was about to say he's not paid mark.
This was after the refurb.
Yeah,
90. I took it to two different lenders.
But this is the problem I find, that people come in the Aberdeen market. They don't, and I've said this umpteen fucking times. The home report's not worth the paper it's written on. The valuation has
it's
to
an
be
opinion.
what you do it.
If you've got a property that's sitting on them, like I have to sort of explain this to people as well, because there is some, without getting technical, there's some bridging lenders that you can get open market value bridging. You know, so you're getting more day one. But I always say, if it's an Aberdeen prop, as soon as somebody comes to me with a case like that and I see an AB postcode, I'm like, where are you, like this home report?
Who's
like,
valued it?
Aye, because I mean, if it's something sat in the market, a surveyor's went out, that's 130, sat in the market for 6 months, and they're not getting bites at 130, but you've got an offer accepted on the market, it's 95.
Yeah.
So what we're saying here is,
value.
rather than 25% discount in Aberdeen, you need to get 50%.
Effectively.
I've been saying this for the last 3 or 4 years. It's 40-50% discount on what and I'm using my fucking inverted comments here, home report is. It's not, that's not the valuation. You're figuring out your own valuation, then you're taking your 25-30% off it.
Aye.
And people are like, what? But that's, look at the discount you've got. You've got half price. It's not half price. That's a fictitious value. The values we've just shared on the market update, they've dropped 6% over the last year. You've got to factor in what the actual value is. Not
I always think for
somebody else
Aberdeen, now again, this isn't financial advice, but I always think for Aberdeen, like, you see yourself and Sam doing it pretty well. You've got to be in the market and know the market really well.
Yeah.
I think where I've seen people get their fingers burnt is like, they don't know Aberdeen.
No.
They just see a home report value
see the
and it's
numbers.
like, oh, I've got a good deal here. And I'm like, unless you actually know the market and you're actually active in that market and you know people there, I would probably...
See, the hardest thing as well for people this is probably going off topic a little bit, but the people that fuck up Aberdeen market is because there's not a lot of sale evidence right now, except from us buying it at 39,995 properties or whatever a heavily discounted valuation is. But see, when you're having conversations with, like, say, yourself or other investors that are putting mortgages through for clients, or they're buying a portfolio, you're actually seeing what the valuations are coming back at, so that they're not going to the market, they're not selling, so no one can physically see that information on the internet.
100%.
But you spoke to 10, 20, 30 investors in the network that are going, yeah, I just bought that one bed flat there and it's valued up at 80. Oh shit, I thought that would have been 85, 90. Oh right, we're seeing a down valuation slightly. Then you're adjusting your end values based on actual real life data, not fictitious fucking numbers, because you can't find a comparable.
And not only that, I mean, to your point, I mean, with that case, I mean, I was like to the guy, I was like, look, this is like, this isn't my fault, but like, fucking, I can. The guy was panicking, and I was like, I can understand.
Yeah.
Have you, like, I can try and challenge evaluations now. I mean, I think I've had maybe 2 valuations appeals successful in my whole time. Like, you'll know yourself.
Yeah,
Valuers will go out, and you can say to them, look, here's all the evidence. Maybe it was a bad day for you. Like, stop being a prick. They just dig their heels. I'm the wrong. So, like, they never change their mind.
I'm a Rick
And how
surveyor.
does that conversation go down usually?
It's not going down well, ever.
I had one. I mean, I'm doing my client in South now, and he literally owns the property, like, adjacent to the premises in Paragon. Paragon are quite a snobby lender. Hope they're not listening. But they're like,
You're listening to your relationship with that BDM.
but no, but they're very picky. And I mean,
Prick, he's snobby.
no, but they are very picky. I always run, because they've got an internal. They're quite good because they have an internal surveyor.
Yeah.
So any case I get, I always refer to them. Say, run it past your surveyor, because he'll tell you.
What's looking?
Didn't like that
Do
one.
they lend in Aberdeen?
They do.
They do, but they used to be phenomenal. But they've just, I think they're overexposed, because they seem to be a lot trickier now.
Like you say, this is interesting, because you said about the appetite for lending changes all the time as well. So a thing that worked a couple of years ago for you might not work now.
But this is like the conversation I like having with other investors and guys like Cameron, because if you're in the know of how to place a deal, like I think I had the other day from Cameron, that Precise don't lend in Perth. PH, why would you not lend in at one of the main sites in Scotland?
Now, Michael Walsh, a great guy, he's a BDM at Precise. He told me, and for the life of me, I can't remember why. I think they were overexposed, or it was one of the only markets when they looked at, because obviously lenders have vast troves of data. They'll have wee boffins and dark rooms just crunching data. And I remember him saying it, like, that was one of the areas where they were either overexposed, or it was like there was a negative.
They didn't like the economy. They didn't like this site. It's weird, but I think that's the importance of having that broker that understands the lender's appetites, has a relationship with the BDM, can pick up the phone, get the right answer. But knowing that if a client comes to you to scale up a portfolio, I've got a property in Dundee, or it's in Glasgow, it's in this area in Glasgow, it's in Kilmarnock, wherever the hell it is, I'm going to put it to these 4 lenders. Let's discuss it further. Let's dig down further.
And the thing is as well, and I suppose it's actually a good thing, if I'm dealing with clients who are doing the buy, refurbishment, refinance method, I know I've only got 6 lenders I can go to.
Yeah.
So it's a case of, like, once simultaneously, because I mean, 9 times out of 10, once I'm lining up the bridge, I've kind of got the mortgage application already keyed, just waiting to hit send as soon as they've picked up the keys or got the refurb.
So I was going to ask you that. What's the time frame? If you're talking through someone looking to scale up a portfolio using the BRR model, you're going to bridge it first. So what type of fees do you think they'd pay? What kind of deposits? What kind of cash they need, and depending on?
As a general rule of thumb, 2% in, 1% out, 1% a month.
Yeah.
It'll be
Factor
around
numbers
about
on
that. Factor numbers on that.
But-
you maybe get slightly better in terms of rate, and you might not have an exit fee, but if the numbers work at that, you're usually in a deal.
But how quickly can you exit onto a normal lender?
So it's kind of flip it on its head. Are you proceedable? I always say to clients, are you proceedable? Do you have a solicitor? Do you, like, and your solicitor is a family solicitor that's done everything for you, but doesn't know bridging?
Yeah.
Because if that's the case, I mean, together, who we've got an agency, we had an offer, like, we submitted the application on Monday, the offer was here on a Tuesday, like that quick. But if your solicitor is,
deal with it.
for lack of a better word, dog shit, and doesn't know what they're doing, then you're going to be 4 weeks in legals or 6 weeks in legals, and it just defeats the whole purpose of it.
Yeah.
You know what I mean? So as long as your solicitor's on the ball and can deal with lender solicitors, is well rehearsed in doing that kind of thing, then it can be as quick as cash. Now again, that's not the case for every bridging lender. But as a whole, they are quicker than mortgage finance.
And how quickly can you exit that bridging finance to get onto that?
Now, with bridging, they kind of deals, I always start back to front.
Yeah.
So I always say to the client, right, we can get the bridge, it's not really an issue. What's the exit?
Exit, aye.
So if you're doing a refurb, how long is it going to take? What kind of refurb is it? Is it just paint and decorating, or is it anything structural? Like, how long is it going to take? How long is your team going to be there? Because, I mean, the amount of times you'll know this as well. If it's a client doing their first deal, I'm in the 6 weeks. I know, you're not in the 6 weeks. I just don't know. Now, as well, back to this sort of point about mortgage rates changing and the market changing, we can't really secure a deal. Mm-hmm. I mean, you can, it's kind of a grey area. You can't really secure a deal.
He's trying not to give me too much here.
You can't really secure a deal if you're going to be finished in 8 months. So you get the keys January 1st. If you're not going to be finished that refurbishment till February 1st, we could look to secure a deal maybe 2 weeks, 3 weeks before you've finished the refurbishment, so they can get the underwriting process done, and then it's just as soon as you've finished the place, the value's out, and then you're done.
So someone that get the keys and they were saying, I'm going to, right, Cameron, I've got this flat, I'm going to just look at the paint, change the kitchen, change the floor, and get it done. I'm going to have done in 6 to 8 weeks. When could you have that application lined up ready for? I would have
the actual application sitting waiting to just click send. The only thing on that is, how do I choose? How do I choose a lender though? That's the thing. That's where it becomes. How do I choose a lender? Because
this goes back to your 6 month thing, right? Mm-hmm. So obviously you're narrowed.
So
down.
I mean, if it's a deal like that, I know just off the top of my head, I'm either going to go LendInvest, Aldermore, Paragon, Shawbrook, etc., FHL kind of thing. Now,
and is this for the long
exit
term?
Aye. So they're buying on a bridge. They're looking to refinance. Because where I see a lot of people going wrong with this. Now remember, bridging is expensive compared to mortgages. So the whole key of getting bridging right is in and out quick.
Fast,
you've got to be quick. You've got to get your. I mean, I've seen it before where people are like, not really. Like they're in no. There's no sense of urgency, and I'm like, this is costing you money like every month, like quite a lot of money every month. Like, get your arse in gear. Where with the mortgages, the key is you need to get your lead times right. So. If what was that? I've lost my train of thought, mate.
If the refurb's going to take 6 to 8 weeks, when would you put in that application?
6 to 8 weeks. Aye. So I would look at it and say, right, I know what lenders I'm going to go to because I can only pick a handful, 5 or 6, right? So I would start sort of scouring the market. You know,
who's got that?
2 weeks after you picked up the keys,
right?
I would have the application in, 3 or 4 weeks before you've actually finished the refurb.
Yeah.
So that. We've packaged the case with the mortgage company, and then it's just subject to valuation. And at that point, you really want to have it where your lead times meet up, where
you instruct it, or you click the application.
The painter's just left the house. The surveyor's coming in,
and then they instruct their own surveyor, which is usually from one of the surveyor companies in the local area.
Now there's again, depending on what kind of investor you are, like you, and he knows Stirling inside out, so he knows what surveyors are good for that area. And if you
don't get that choice, do you?
No, really. I mean,
the broker doesn't have any input to that.
No, really, no. I mean, if you tell me, I think DM Hall or Allied, like I've got somebody in there that I really want to use, then I could say, right, well, I know that this lender uses them. I can go to them, but here's the rate compared to. It might not be the best in terms of the actual rate, but for some people it's like I'm not really bothered with that because I know I'm going to get that valuation.
So you'll pick up the valuation cost as well. You've got the 2% for the bridge, the 2% a month, the 1% a month, the 1% exit. Mm-hmm. Then you've got, or unless it's going to be a next.
I mean, the bridge as well. You pay for the lender's legal fees.
Yes, so you've got lender's legal fees, and then you've got your valuation again to come off it. Mm-hmm. But this all
some products. Now some lenders will offer
free vouchers,
incentives, and then that changes all the time.
Aye.
So it's like Aldermore are pretty good for that. They do free.
This is the importance, I think, of having that broker on board, like to stack up all your numbers, because technically, like we've not even covered the interest rate, the arrangement fee, the valuation, the legals. You stack them all together and you go, right, are you fixing it for 2? Are you fixing it for 5? What's it looking like over that period of time? Mm-hmm. Here's your best lender, not necessarily the high line figures that you're speaking about. Oh, there's somebody offering a 3.9% mortgage.
I found a 3.9%. It was a personal buy to let. It was a 5 percent arrangement fee,
47.
but it was only 50%.
Would have been a high street, was that HSBC or Barclays or
It was
something
like
like that?
Bank of India or something like that.
I mean, they're like, they're just pretending. A lot of them do that as well because we have sourcing systems.
But people would look at that though, wouldn't they? They would just look at it and go 3.9, fucking great, and they'd base their numbers on 3.9.
I always say to clients, rate is like the tip of the iceberg.
Yeah.
There's so many other factors that go into
It's a
that.
headline grabber, isn't it? Because
100%.
that lender have now got a news article that's all over social media and all the rest of it. So it's PR for them. It's a PR
Not like
exercise.
that. Here's a scenario, right? You've got a lender that's rapid, like like I'm talking mortgage lender here, like LendInvest. They're really good at the minute. Like
system's slick.
they're so quick. They're a fintech company first and foremost. So like you didn't have to print out and sign a direct debit mandate and then scan it to me, which I didn't want to be doing either. I didn't want to be doing either. By the way, that's like a bollock for me. Like just processing time for me. So like the fact that they can send you an email for you DocuSign, everything just gets done like quick as anything.
Who's the worst? Slowest?
Can I say that out? I mean, at the minute,
No, I mean
at the minute,
you're
I would.
reckon as part of your relationship as a broker to them, they're obviously wanting your feedback.
Aye.
'Cause
No, I mean,
you're doing-
at the minute, I would say Shawbrook probably their service levels have been pretty poor. But
I think they go up and down depending on how busy they
this is what I'm saying. It's a swings and roundabouts because like 12 months ago, Shawbrook were my favourite lender. They're so good on criteria. They're really quick. They take like a common sense approach to pretty much everything. But what happened was, I think it was about a year ago, they still lent. See when trust crashed the economy and swap rates went through the roof and everybody was panicking, they were still lending. Like they didn't really change the rates all that much, to be fair. So they got absolutely inundated with business and service levels just kind of just went through the roof. Went through the flare. Now, so I mean, at the minute they're probably, I would say, the slowest. But again, I've had every case is different. Like you say that one I'm talking about just before we went live. I went for application to physical offer. Application to offer with a physical val in 6 working days. That's quick for any lender.
That's rapid, yeah.
That's really quick. I mean, there's some bridging lenders that aren't even that quick.
Yeah.
So it's just a case of, every case is kind of different. Now, in the scenario I'm going to run you, where rate isn't everything. If you are on a bridge, it's costing you 1% a month, right? So say you're on a £100,000 bridge, £1,000 a month, right? Could say LendInvest is 6.5%, and this other lender's at 6%, right? But LendInvest, I'll get you off that bridge
rapidly
within 4 weeks.
Yeah.
But this other lender is going to drag their heels and you'll be in that bridge for 3 weeks. Well, it's cost you £2,000-3,000
extra on top of
extra on top of. So that 0.5% that you were trying to save chasing a rate, it's been swallowed up.
Yeah.
You know what I mean? So there's loads, and I always say it to clients, like, look, rate's not the be all end all. Obviously, we're trying to get the best rate, but it's what's the best lender for your circumstance, all things considered. You know what I mean?
See, I think this is an important bit. That's what I wanted to ask you this question to cover it for like maybe the people that are starting out going, I want to scale up a portfolio, I want to add 10 properties to my portfolio in a year. They're going to need to do this. They're going to need this knowledge. They're going to need a broker like that on their side that can get in and out in 6 to 8 weeks off from the purchase of buying a buy-to-let with a bridge to exit on a long-term finance with their money back out and they're on their next deal lined up. That's the only way you can do it.
Would you engage with somebody like, say, so for the listeners that are listening to this and they've basically they're wanting to do a wee bit more creative strategies like the BRR and all the rest of it, right? Like, would they come to you quite early and would you engage in them to say, they're coming to you saying, look, I found this property, like they get, the guy.
I always encourage it. Always run it past your broker or somebody first. The worst thing you can do is fly into a deal.
Commit to it.
Aye. And one of the big trip ups for that is if somebody's starting out early, they'll typically look for the lowest bar at entry, and that's usually your high yielding flats or
40 grand flats,
that kind of thing. But a lot of them are non-standard construction.
Aye. And a lot of lenders won't lend
Don't touch it.
Minimal criteria.
So like they're like, oh, I've got a great deal here because on paper yields looks like your double-digit yield, hardly any money in. You're like, oh, this is fucking brilliant. But one, your bridging costs are going to be quite high at that, because I mean, as soon as you go below 50k, if you're buying something below 50k, your bridging it's the economies of scale, so it changes. They charge. I mean, if you're borrowing 35k, but your solicitor's fees is 1,500, £2,000, that's a big percentage of the loan.
It's huge compared to
and you're still paying the same value or fee, etc. So your fees proportionately are bigger, and then on the exit, and this is a thing as well I've seen, on stuff that's valued below 75k, you're very limited on an exit who'll lend on it. 50k is kind of the threshold for mortgage finance, but when I say threshold, there's only a couple of lenders that'll consider stuff at between 50 and 60.
75 valuation on the end value, or the
75 on the end value. 75 on the end value.
Yeah.
Right.
That's quite important, because people need to keep that in mind. They'll go for, like you say, go for these deals. They get this low hanging fruit, and then they go, "Oh, well, can I fucking exit?"
This is to your point. I mean, if a client's coming to me and saying, "Look, I've got something at 45, I'm going to spend 10 on it. It's got a revalue at 65." I'll be like, "That's great." If you got a home report, because I always check. First thing I always check for construction type, because in a lot of these ex-local authority areas, the Central Belt.
Yeah.
I mean, it's weird. I still come across every week. I'm like,
what the hell's that construction?
Everybody somebody will be in the Go Financial chat. You ever heard this construction type? Nope. Like, what were they building on?
We had a client, a landlord, and he listens to the podcast, so he'll know exactly who it is when he listens to this. But he gets stuck with that non-standard construction. The deal looked amazing on paper. Everything was, they did a fantastic refurb. Just couldn't get any lender. Or they could, I think they got one lender at the back of it. And they didn't bridge. They had private investor money, which they were like, we need to pay them back.
That's something as well. See, if people, because I know it's a big thing that people working with private investors, one thing you've got to consider is on the exit. I mean, if you're buying something, because somebody might look at it and go, actually, it's less hassle. I can get a private investor to just go in this. What kind of security are you taking a personal guarantee, or have they got first charge? Yeah. Because if they've got first charge, that can affect who'll lend on the back end, even if you're very vanilla.
Yeah, there's quite a lot of lenders that won't like private use.
And it's all to do with regulation. I mean, I'm not going to go bore people with what FCA regulation and all that. But
that's another thing you need to know about that.
100%.
Well, if that's their plan.
What happens if your client's not honest with you? Because I've been there before with a couple of brokers where you know they're not going to. When you say I've used private investor finance, they know they're not going to be like, get a mortgage, but if you manage to hide it creatively, they put it through and they don't know. But yes, I think that's something you ask your client up front. Did you use private investor finance?
Because there's always a way.
Well,
I say always a way. There's usually a way. That's probably I should caveat that. But the one thing, if you come to me and you're hiding information, I would usually pick up anybody and be like, "Nah, I'm not dealing with them." Like,
do you know it's like a bit of like red flags things when you look at deals? It's like imagine if I said to you, right, Cammy, can you exit me a flat above commercial in Aberdeen? It's 50 grand value. It's non-standard construction. You'd be like, fuck off. I had an inquiry for a guy, great guy, but he was like, I've got a flat in Aberdeen, grade A listed building. It's in it's like one of these high-rise flat, like a Grenfell style flat, commercial on the bottom aspect to it. Yeah. Valued like 60k. Can you get me a lender? It's like you've got one option, and your rate's going to be like 9-10%. That's your option. Like, simple as that. Yeah. If the numbers didn't work at that, you just don't buy it.
Didn't buy it.
Aye, that's interesting actually. To switch up a little bit from the BRRs, because I think that was quite a good chat, that people can see that even though the buy-to-let market's taken a beat in the last couple of years, you can still scale up a buy-to-let portfolio using the BRR strategy, even in today's lending market. Just make sure you know
100%. There's more deals coming up now.
Oh yeah,
because I wouldn't say there's blood on the streets, but people are feeling the pain.
It's getting there, yeah.
And you'll know yourself. 18 months ago, you couldn't get anything. Yeah. It was so hard to get anything for home report or even close to home report. Now people are entertaining cheeky offers.
And what do you think is a conservative rate then, that people, obviously we've got our spreadsheets, we're doing our deal analysis.
At the minute, 6.5, I would say. That's a reasonable rate. Now, I would say if you're going to be uber conservative, stress it at 7. Now, because when lenders are actually stressing on this is I don't know if you're going to pivot to arrangement fees and whatnot, but that's a big thing at the minute. People are like, arrangement fees are ridiculous, and I'm like, I agree with you, but it's a solution to a problem. Lenders are looking at it and saying, we're borrowing at 5%, right? If we lend to you at 5% and didn't charge a fee,
we're making nothing.
Lenders are daft. They're going to need to make money. That's what their business is. So lenders are looking at it and saying, right, well, we can charge you 5%, but we need a margin on the front end. So 4 or 5% fee for a 5% rate. Now, the good thing about doing it that way is, and where this is kind of, there's a couple of lenders that were doing 7% arrangement fees, and I can hear people with pitchforks already like, that's fucking ridiculous. That's greed. But if think about people that are in like centre of Glasgow, centre of Edinburgh, where the yields know the best. They've been on a 3% rate, and they're looking at even just a like-for-like remortgage, and it's a good tenant, so they've not put the rent up, and they're coming to do a like-for-like remortgage, or they're going to go into the variable rate 8%. They're going to be bleeding effectively, hemorrhaging cash, you know, what option have they got? So even on a stress test, even if it was like they were breaking even on a pay rate at 6%, lenders not going to lend to them, because lenders have to stress this to be, you know, for regulation purposes and to actually make sure it's sensible lending.
Yeah.
You
Just
know,
so listeners understand the stress test.
Let's talk about that a little bit. Yeah.
So like, you explain it.
So if I'm lending you money, right? The pay, when I say pay rate is the rate that you're going to pay on the mortgage. So if it's a 5 year fix at 5%, the pay rate is 5%. Lenders, now again, it's hard to say because there's not a one size fits all approach, and it depends between a 2 year and a 5 year. 2 years are usually stressed higher than 5 years because it's a shorter period of time. So a lot of lenders will stress pay rate plus 2% or 2.5% depending on the lender, and then also
against the rental income.
Aye, against the rental income.
See when you're saying pay rate, sorry, what do you mean by that?
So if you've got a mortgage at 5%, 5% is a pay rate.
Right.
So they would stress that at 7%.
Right.
Does that make sense?
So
Right.
your rental payments. So this is when they're looking at your rent. This is where people are getting caught
Aye.
out.
Yeah.
Sorry, I probably should have mentioned the rent. So they'll look at the rent
Yeah.
and stress the rent at a 5% pay rate plus 2%, so 7%, and your tax liability also comes into it. So if
Right.
you're a higher rate taxpayer, they'll stress at 145% of that payment. Whereas
How much does that need to clear? How much does the rent need to clear?
145% of the the mortgage payment, 2%, 145% of that's where your rent's got to be. That's tight.
Now that's if you're a higher rate taxpayer. Now
Right.
this is where the whole
What's it, 138 or something? Is that low, right?
that's 145 is what most lenders will stress it if you're a higher rate taxpayer. But if you're a limited company or basic rate taxpayer, it's 125. So it's 125, and some didn't even do that.
Right.
But it's just to give you a sort of conservative. If you're stressing deals,
Yeah.
here's how you do it. Now, obviously, if you're getting rates at like 6.5, lenders are having to stress at 8.5%. No lot works at 8.5%.
No.
Especially in higher value properties.
This
For
is
example,
Edinburgh.
City Centre Edinburgh.
Buying tenanted stock has been a killer as well. Like, there's a lot of things that deals up.
100%.
Folk kind of exit their private investor finance or their bridging finance on a long-term debt because they've not understood how
Aye.
it's stress tested properly.
100%.
What's your view on that? What's your view on the private investor? Because you see this getting put about all the time. A lot of people doing this strategy.
I mean, there'll be a success story and horror story for every different scenario. But me personally, I think people that use investor finance, if you're going to go investor finance, you need to have. It's probably piss a lot of people off, but you need to have done it yourself first. You need to, like, if I'm investing money into somebody, you can't be fresh at a holiday and done a weekend course and I'm going to give you 100 grand to go buy
Unless it's going to be your granny's money, which you'll find a lot of the time these people that are getting their private investors is
From the close friends and family, yeah.
Now, if you say where I see it working really well is you've maybe got 2 or 3 buy-to-lets, you've done a few projects, and then you're like, if you have a conversation with your mate in a pub or something, I don't know, and you can get 100 grand to then go, supercharge your portfolio or whatnot. That's more feasible because then you've already got equitable assets in the background.
And
You've
the
got a track
background
record,
yeah.
and even from a lending point of view, well, you can sort of see that there's experience there. There's experience there. There's a track record there. Now, back to this point you were making earlier on. Didn't ever try and hide it for. Because some lenders aren't the right way, but some lenders are. But you need to tell them. Because what you didn't want to do is go through the mortgage process, all that, and then because it'll get picked up in legals.
And then you will piss your broker off, the lender off, everybody off because
you've wasted 3 months of your time. You've maybe damaged a relationship with a estate agent, whatever, just because you thought,
I'll be able to find this.
You know what I mean? So I always say, just be upfront about
it.
Yeah. Now. It can work, but I've seen it go wrong as well. One thing I will say is you've kind of got to be careful with what security you're giving them. So, if I'm an investor, what are you giving me? Personal guarantee? Are you giving me a first charge on the property that I'm back, like that you're using the money to buy? Like, how is it working? Or am I getting a floating charge on your company? How's it working? So there's all the kind of things you've got to consider if you're approaching an investor or you're using investor funds. What's the actual nature of the agreement?
Because that's going to affect.
Because that will affect the back end, how you're actually
I
going
think where some people are getting caught out here is because this was all fine when you could see all these people on social media saying don't keep your money in the bank at 0.1% and all the rest of it. Like, invest it with
By
me.
the way, that's
I fucking told you that for years now.
I mean, the FCA is never going to. I mean, if you're some guy on Fedander Hall like me and you're putting on Facebook, why are you going to have your money in the bank for 5% when I can give you 12%? I mean, the FCA hasn't got the manpower and resources to go, but technically speaking, you shouldn't be doing that because
you're breaking a whole lot of
you're breaking a whole lot of financial.
What I was saying is that was all well and good, pre-rate rises and all the rest of it. But now
you're getting 4% in the bank.
You're getting 4% in the bank.
Banks are actually, like you say, caught up a wee bit now. I mean, they have been slow to pass it on to savers.
Oh, of course not.
But there's now I bet there's some people going, right, okay, a lot of the times this private investor money has come from people who are not really, they don't know about property and all the rest of it. They've just thought this is a good idea, but now they're like, oh wait a minute, the property market. I'm reading these headlines saying the property's going to crash and all the rest of it, and I've given my 100 grand
at 5%,
do you know
and
what
inflation's sitting at 6.7 apparently.
And they've got it in property. Wait a minute, I want my money back now. I want to just stick it in the bank. Do you know what I mean? So there's some people getting caught out now because they're asking for the money
100%.
back. The people that have invested it in the property are now, they're like, oh shit, I can't get it remortgaged because I'm
not only that, with the terms that you've got your investor, how often is that reviewed? 5%, is that for 5 years? Is it for 10 years? Like, how is that? Is it just 5% per annum? Because if you've, like you say, if you borrowed for somebody at 5% 2 years ago, put any of these deals, right? You've got this portfolio now, like a couple of properties, and they're cash flowing well. Remember, you can't put rents up. If you've bought something on a 2-year fix, you're getting squeezed on interest, and any savvy investor is going to come to you and say, by the way, 5%, nah.
No.
Either money back or I'm being 10, 12. And then suddenly you're like, this isn't even, I'm in hot water here. So that's something you've got to consider as well.
To get the money back out because my stress test doesn't work anymore.
Doesn't work, aye.
There's a lot, you need to be really on the ball with the numbers right
100%.
now. And understand where, and this is why we cover this stuff on the podcast, is talk about the lending, the interest rate, stress test and all that. You need to be aware of the whole lot.
100%. One, like, it's actually like, see, when we send out a key facts illustration to a client, it's so funny because I know for a fact 95% of them do not read it. Do not read it because in it explicitly states, here's what your mortgage payments.
You don't read this. You don't read your text.
Here's what your mortgage payments will be if rates go to X, Y, Z. Yeah. So they'll usually say like 3. So if it's a 3% you took out, here's at 6%, here's at 8%, here's at 9%. Can you please make sure you can afford these payments
when it doubles?
The $1 million question: 2-year fixed rate or 5-year fixed rate? What are you going for?
Crystal ball. Couldn't tell you. It's very, there's no one size fits all approach. Right. It all does depend on your personal, like where you want to go with your portfolio, where you see, a lot of people come to me and say, I'm happy to take a 5-year, even at the high rates, I'm happy to take a 5-year, got cash flow well, I don't know what to worry about it. Whereas some people are like, looking at economic projections, I can't see the rates staying where they are. They might dip. Now, will they go back to 3%? Probably not. Hope so. Probably not. But they're not going to sit, like 2 months ago, they were like really high. They were sitting like 6.5, some were even at 7. So some people would be like, I'm not fixing at 7 for 5 years. I'll take the risk. 2 years, it's going to come down maybe 5%. I'm not fixing at a unnecessarily high rate for an extended period of time.
I'm thinking though that you're saying, about the higher arrangement fees and all that, and that's not necessarily, obviously it's not great, but you were saying it's not necessarily too bad. But if I'm having to pay a 5% fee, 5% would be quite a lot, but I don't want to be paying that every 2 years.
This is the thing as well. Unless I've not recommended it to anybody, but unless you were in a dire situation where you're like, you've got a flat in Old Town Edinburgh, I'm just thinking of a scenario where this would be applicable. Because I remember actually having this conversation with like lenders, like, you like 7% on a 2-year fix, like, who the fuck's buying that? That's like, that's more than tax.
That's bringing
that's criminal. It's no criminal. It's probably the wrong word to use, but that's like
profiteering, isn't it?
Aye. But to the lender's defence, if they're looking at it and saying, well, in order for this deal to work, you need to be at 4.5% for the stress test. Only way we can give you 4.5% is if we front load the interest. So, and I mean the 7% and like the 5%, like the high arrangement fees, when you look at them and you're like, oh, that's quite But if you actually average it out,
My worry on that with the arrangement fees is most arrangement fees, or most people will add the arrangement fees onto their loan.
yes.
So
Now
you've leveraged higher. So
Aye.
I've just fixed a shitload of properties at 5 years. They're all 5% arrangement fees, and I'm thinking at the back of my head, going, do you overpay to pay off the arrangement fees over the next 5 years with the cash flow? Because if not, if you've got no
capital growth, you're sitting at 8%.
8%.
That adds on to the next loan.
Aye, and this is where I.
So when you come to refinance, you've got to factor
That's
that.
absolutely something you've got to consider
This
as
is where
well.
I think the whole visual portfolio.
The only, I mean, if you're sitting at like 70% or 75% close to like sort of lender thresholds, it's not really a suggestion I would ever be comfortable really recommending, to be honest with you, because like you rightly say, you're sitting at 80% LTV. If you've got no capital growth, which isn't guaranteed, by the way,
you may get a drop in prices in the next 2 years.
it could, it very well could. You know, in 2 years' time,
6% Aberdeen.
all you're doing is effectively kicking.
Minus 6%.
All you're doing is kicking a can down the road,
Kicking the can down the road, aye, absolutely. Yeah.
and that's never a good, never a good idea.
No, but it's so important to have that holistic view, your portfolio, your strategy, being sensible with it. Is it repayment mortgages?
I always say to clients as well, like, what is one of the qualifying questions? Why are you buying property? Is it because, like, for what's the goal here? There's got to be a means to an end.
So there's too many people I think do fucking buy a property because they want to buy a property and look cool on social media.
There's a bit of that.
Look at the numbers.
There's a bit of
Stack up.
the big swing and dick kind of thing. A lot of people as well, though, the people that I see getting their fingers burned are the people that, like, and this isn't back to bash. I done a course. Like, I fully would say if it's for you, it's for you. I'm not sitting here to bash courses at all,
Don't
because
worry, I'm here to do that.
He's there, that anyways.
like it's. But where I see people that have went wrong is, and I can empathise with it because I hated my job, right? But they go into it, right? I'm gonna go buy 3-4 buy-to-lets to replace my monthly income, and I'm golden, and that's me financially free. That's a short-term thinking.
Very short term.
Very short-term thinking, and the people that have done that are probably the people that are like, if you're going into anything with that kind of mindset, it's short-term thinking never wins.
Yeah.
Just doesn't. Long-term, it's long-term thinking always, doesn't matter what aspect test you look at, that's always going to prevail. If you're looking at something and going, how do I replace my income of £2,000 per month as quickly as I possibly can in property? Good way to think, but it's no a long-term solution. Yeah. And that's where I see a lot of people that I can tell, you know, where they're like, oh, my rates are I'm getting squeezed on rate, and now, can you imagine, right? You've got 4 buy-to-lets, you were cash flowing at £500 a month at 3.5% what they were 18 months ago, and now your refinances are coming up. You've left your job, and now all of a sudden
You've lost your income, or half
your income's been decimated. Scary place to be in. Really scary place to be in. And then, so what's your option at that point? Do you sell? Because then you have to get a job. You know, that's the whole thing. You know,
I've spoken to a lot of investors recently that have said this to me. They're getting a job. They've been so heavily focused on a single strategy that's now not working out, or they're overexposed to something. They're going, I'm going to have to go and get a job.
See, like, this is the thing. I mean, even rates there now, historically, rates are sitting maybe just slightly above average where they should be. Where we were for the last 14 years was an anomaly.
Yeah.
Like, you were borrowing for free, effectively. You were like getting free money. Now that rates are gone back up to sort of normal levels, a lot of people are like, oh, it's that panic, it's that.
You're seeing the panic from the newer investors, but I think you're seeing the more old heads prevailing again.
100%.
What's your view on you know, obviously paying down the debt, and you hear a lot of people saying, well, I'm reducing my LTV, you know, like, obviously these must be people that are obviously not needing the cash flow.
Aye.
You know,
it's all about managing risk. So if you're looking at it and saying, right, now this answer will depend to different people. Like, I'll use you an example again. He's like, just leverage to the hilt and just go and get as big a portfolio as I can at the minute, and then once I get to a certain level, then I'll start paying back down the debt, or have some sort of strategy towards it.
You know what's funny? Nick got called out by somebody saying, what was it, overexposed Stephen or over leveraged Stephen or something like that? And I was calling you negative Nick. My loan to value is 56.2% of my portfolio, actually. I'll put that out there to the negative little prick that came in and said to Nick that I'm overexposed.
I've not told him, for the guy that's listening, I've not told him who it was that sent me that Instagram DM.
But this is the thing, it's all about managing risk. So if you're at the start and you're like, I just want to go big, then
You need to clean up behind you.
That's a brilliant way to say it. You need to clean up behind you.
Yeah.
So even using the BRR strategy, one thing I would say is like, see if you're doing the BRR strategy, you're buying to build a portfolio and then you're refinancing to the new value. Leave it at the new, once you've refinanced and took the equity out, leave it there.
Yeah.
Leave it there.
I found that very interesting when I started looking into Aberdeen, and it almost showed you like this the things that investors maybe did wrong when markets were good. They pulled out more money. They re-leveraged. And I think I've done that once in a property I'm just selling in like a few weeks' time. And it's quite annoying because the mortgage is higher than it should have been. I'm like, fuck, I wish I hadn't pulled that extra bit of cash out of it. But all the investors that couldn't sell their property at a certain price was because they'd over-leveraged at a point where it wasn't worth what I could even offer. They wouldn't even clear the mortgage off.
Oh, yep.
And you're like, that's a fucking really, really horrible position to be in, isn't it?
As soon as you've got like an actual sizable portfolio,
Yeah.
so anything over really 10, I wouldn't be sitting at 75% LTV. Because like you say, 75% loan to value, arrangement fees, you're adding them to the loan.
Yes.
Right. Now,
You're at 80. Any market drops.
Any market drops, you're then in hot water.
Yeah. And if the market's not in a place where you can sell at market value, which we're seeing right now, you can't sell a tenanted property at market value. You have to give an investor a good discount of 20-30%. I don't know. So it's a sticky place to be.
Do you have some clients that are on, interest and repayment?
I mean, some clients prefer to do repayment. The only thing with repayment at the minute is because where the struggle with repayment is at the minute is if you're trying to refinance on interest only and you're struggling on stress test, repayments almost just out the question.
Unless you're loan to value.
Unless you've got a really low loan to value, in which case.
I mean, I've often thought, looking at it again now, to take away that risk and to take away that, because I'm 75%, I feel quite vulnerable. You're exposed to
Any market changes.
in interest rate. What a great way to be. If I fast forward 20 years time, and I'm 65 and I'm sitting there, even if I've
45, you look 45.
43, mate. Getting close. Even if I fast forward that 20 years, and again, this is where property becomes for me the long-term game.
Yeah.
And I'm looking at that, if I start paying that down, and even if I only have 6 properties but have no debt, what a great place to be.
100%. Not only that, it's a snowball effect because remember, at 75%, you're paying the most amount of interest you will pay because you're leveraged at the most you can leverage. So if you start paying that down, your interest comes down, your cash flow goes up, and you can pay more down. So it's like a parabola. Over a long period of time, you can actually pay it off quicker. Over a longer period of time. If I would say just chip away. I mean, if you're on fixed rates, you can pay up to 10% usually, without incurring any ERCs. I would say that's if you can do that in this kind of climate, I would probably say do it.
Have you got any properties yourself?
No, there's no. I got into the mortgages and that because I thought, right, I'll build up cash flow and then start buying properties. But that was 2018, 2019, and in that sort of space of time, I've even just seen how the climate's changed for like legislative and government, and I'm just like, no. Like the thought of me buying a place, and this is maybe, I don't know if I should be saying this on the property podcast.
No, but it's interesting.
But the thought of me buying a place, just the way I'm wired, if I buy a place, right, now I completely agree we need legislation to stop shitty landlords and rogue landlords. I am 100% for that. But we're now in a situation where like we're unnecessarily punishing landlords, and without getting political, they're the easy people to target. But since I've seen it, like you're telling me I can buy a property with my own money, provide a house for somebody, they can then turn around and not pay me, and I'm one, can't put up the rent, two, it's an absolute bollock to try and get them out, and they can trash a place, and it's like that to me is just like
risk appetite,
and because so I mean, my main focus is obviously growing the business as big as I can.
Because
what do you think? Sorry,
no, I'm just thinking from Cammy's point of view, being 24, 25, looking at it from he's dealing with investors day in day out, looking at scaling up portfolios, and he's not inclined to get involved. And it's nice to see from both sides. Even
at that, if you look at it in Scotland and England, if I was going to buy it, I'm buying in England. I'm better from a tax point of view, and they're no like polar opposite to us, but there's less
3% difference in ideas.
It's just the whole political side of it where it's, and I'm not going to get political at all, but like up here, it's like we have to be different to just say we're different, and I just feel like it's so unnecessarily punishing, and it's an easy political grab. Landlords, greedy landlords, it gets a vote. But when you actually look at what's happened since they've introduced this cost of living stuff. It was meant to help renters. One of my clients, right?
Punishing them.
I'll use a story. One of my clients, guy in Dunfermline, very high income earner, went down south to manage a hotel. He then had two opportunities, right? He could either come back up to Dunfermline to manage I think it was one of the ones in St Andrews or something, or he could go to the Maldives. He had two job offers, right? He was wanting to come back to Dunfermline. Now, we had changed his residence to Capital Race to put in a buy-to-let.
Fucking heating easy. She's tested Maldives or Dunfermline.
I know. I had that conversation with him. But so the backstory was he had refinanced his residential house he had in Dunfermline when he moved down south, turned it into a buy-to-let. Now, obviously, he can't go live back in that because that's like a total no-no. So he was looking at it saying, look, he phoned me, he's like, do you know anybody rent anything in Dunfermline? And I was like, no, like, speak to a letting agent. He's like, I can't find anything. I'm prepared to pay double what anybody's asking because he can afford it. He's like, 6-figure earner. He's like, I will pay double. I just want to come back to Dunfermline. I can't find anything on the market. That's the market at the minute.
Yeah, it's ridiculous.
Can't find anything. So now if you think about it from like a government point of view, that's a high income tax earner now out the UK. He's now in Maldives.
Need to convert that garage into a spare room, mate.
Oh, it's coming.
And everybody says the same. Like, you
lettings.
Like,
wait a minute, just touching on that then. Obviously, you're talking about focused on growing the business and all that, and you must be doing all right because you've got four or five guys.
5 guys, one come on now.
So you're doing well. Eventually, you're going to want to invest, or have you started investing already? Where are you going to invest your
millions? See, I'm kind of fortunate just because of the way I'm sort of placed in transactions. I can see what works and what does, like we get a first-hand view on. We're basically sitting on the shoulders of successful investors, saying, "Oh, look what he does! Look what he does." Now, buy-to-let absolutely still works. People that say buy-to-let is dead are just that nah. But for me personally, I'd just much prefer because I've started, dealing with commercial investors. That just appeals to me a lot more. You've got the FRI.
Yeah.
I mean, they've not got the same level of volume in terms of you might be your vacant periods might be slightly longer and all that, but the client's got to hand it back to you. Your tenant's got to hand it back to you. How they found it.
Yep.
And not only that, even for like an investment point of view, you can increase values just by changing lease structures and all that.
Yeah, my commercial unit, I agree with you. 28.8% return on it from what's cost me. Like, you're not getting any buy-to-let.
Crazy.
That's fucking insane.
Aye.
On a 5-year FRR lease, like, doesn't cost me any maintenance, doesn't cost me any issues.
The whole sort of challenge with the commercial market is at the minute, obviously commercial is valued slightly differently. Usually it's a commercial valuation which is driven by the yield. Now, as soon as interest rates goes up, yield comes down, the values come down. So it's kind of that sort of swings and roundabouts. But even if just, if the government was to turn around and do a complete U-turn and almost deregulate the buy-to-let space in the sense that you can charge market rates and you can evict tenants, then absolutely that would become much more appealing to me. And if they dropped it for 6%, why am I paying 6%?
It's a lower entry point for you
100%
than a commercial. Yeah, I get that. Yeah.
I mean, commercial, and that's what I've kind of looked at and said, well, commercials, it's a higher barrier to entry to really
more cash
go for it. But that's what the big boys do. Eh? So
yeah, absolutely. Most people use a buy-to-let portfolio as a stepping stone as well.
I was going to say it's almost a natural progression for a lot of buy-to-let landlords. I've seen them. I look at my clients who 20 plus, and they're like, I'm going to start doing commercial.
Yeah, it's time for HMO. It's time for commercial. It's time for new builds. It's always that progression. Yeah,
progression.
Just before we wrap up, I'm kind of cautious that a lot of the listeners are probably sitting here with portfolios and they're maybe seeing opportunities, seeing the fact you can pick up portfolios at a significant discount. The clients you're getting right now, how are you helping them scale up their portfolio even in a bit of a tricky time? So
it's all about looking at your equity position. If you've got a portfolio there, how are you leveraged? What's your loan to value? Because one of the most powerful things about bridging compared to mortgages, if you can use bridging, and use your equity that you've got there in your portfolio, so that you may be looking at how common is it for buy-to-let landlords to be cash poor, asset rich? It's just that's how it is. Now, if you've got a portfolio and you've got quite a substantial bit of equity there, and you're not sitting on cash because it's in other places or whatnot, and you're actually saying, there's a couple of deals came on my desk, this is actually of interest to me. Well, then you can look at it and say, well, this equity you've got here, you can leverage that as a deposit on buying a portfolio. Now, the portfolio you're buying, yourself, if you're buying at a discount, then there's scope for you to potentially use that towards the deposit as well. So
by buying a discount,
100%. I mean, I don't know anybody that's buying portfolios without a discount at the minute.
Yeah, exactly.
It's just
be silly.
I don't know why you would do that.
I suppose that let's look at the upsides of that is you can scale up your portfolio quite quickly right now. But the downsides is I'm assuming that a lot of the stress tests are not going to stack up for a lot of the lenders to come off.
That's the thing. A lot that is the problem that's kind of plaguing a lot of these kind of transactions, where if you're typically buying a portfolio that's got tenants in it, and the rent is quite low, so
and the interest rates are now higher.
So then I always say to clients, it'd be easy for me to go. I mean, I could be a total shark and just go and get bridges, and then.
But you need to make sure your clients can.
You need to make sure they can exit 100%, because you could ruin somebody's life doing that. So you've kind of got to look at anytime you're doing bridging back to front, how are we exiting this? What's the exit strategy? You selling this? You selling some of the portfolio? What are you doing? What with the tenants? What's the scenario there? Is any of them moving out? I mean, what's the script? And this is where I think if you're buying portfolios at that level, it does help to have a kind of bit of background, a bit of experience about you, because then you know yourself. If you're a complete newbie trying to buy a portfolio, there's a lot
of moving parts.
There's a lot of moving parts there, and there's a lot of things where you're like, have you actually considered this? With the tenants, etc. How are you going to manage that? So, there's no. I could say talk about this for hours, but
how much do you charge for a standard just buy to let mortgage?
It's £500, 150 at the outset, 350 on offer.
Cool. So if anyone's listening to this, they want to get in touch,
absolutely.
Where's the best place?
On Instagram, Cameron Leslie 99, or I'm on Facebook and LinkedIn, Cameron Leslie.
It was really refreshing. I thought this was great because I just think that, like you say, your industry has kind of got a lot of kind of people who are almost want to put up barriers to you. But I just feel, talking to yourself, you get a lot of energy. You're obviously well informed, especially with the strategies of property investing and stuff like that, which helps because I feel like you're on the same wavelength as people who are wanting to.
He's had the education, he knows what he's doing.
Be a deal doer, that's what it is. That's
be that facilitator to make it happen.
100%. That's what my job is.
Good. We'll post your links in the show notes, mate, so people can reach out to you as well.
I appreciate that. Happy to help.
Right. Thanks for joining us.
Thanks for coming in.
Thanks for taking my virginity.